The Fed just sentenced your cash to failure. Hey guys, welcome back to my channel. In today's video, I'll be talking about how in their recent meeting, the Fed has just doomed your cash to failure. And I'll be sharing with you how to inflation-proof your money. So if you're interested in finding out how to protect and guard against inflation, make sure you stick around in this video. Before we start, there are some things that you need to know. You need to know that as the central bank of the US, the Fed or the Federal Reserve has the power to influence both inflation rates and interest rates in the economy. In fact, it is not just the US economy. The actions that the Fed take has also consequences on other economies as well. How the Fed influence inflation rates and interest rates is through their fiscal and monetary policies. We'll now take a look at how central banks, specifically the Fed, affect interest rates. The Fed controls the discount rate. Discount rate refers to the interest rate charged to commercial banks and other financial institutions for the loans that they take from the Federal Reserve Bank through the discount window loan process. The discount rate is basically the interest rates that central banks charge commercial banks and other financial institutions for the money that they borrow from the central banks. If the Fed chooses to lower the discount rate, this means that the cost of borrowing of commercial banks and other financial institutions is lowered, and as such they can pass down this cost savings to their consumers in the form of lower borrowing costs. One way that these commercial banks and financial institutions can lower the borrowing costs for their consumers is through lower interest rates. And this is how the central banks can affect the interest rates in the economy. In its recent meetings, the central bank policy makers appear in no hurry to hike rates, continuing to bank rates to remain near zero through 2023. In fact, the Fed's interest rate outlook for 2021 through 2023 was 0.1%, unchanged from previous projections in December. What this means is that the Fed continues to project and believe that interest rates will remain close to zero at least until 2023. And even though this is just a forecast and projection by the Fed, we still have to pay close attention to this. And the reason is because the Fed, through its fiscal and monetary policies, has the influence to affect interest rates in the economy. So if the Fed projects interest rates to continue to remain near zero up to at least 2023, this means that the policies that they will implement in this period of time is likely to accommodate their projections. And with that said, even though we can't predict the future, we can be sure that with the massive power and influence of the Fed, interest rates are likely to remain near zero up to at least 2023. So that is the interest rate side of things. Now let's take a look at the inflation side of things. For inflation, the pace of inflation is forecast to improve to 2.4% in 2021 and 2% in 2022. And looking ahead to 2023, inflation is projected to reach the 2.1% target, up from 2% previously. And in the meeting, the Fed continued to reiterate that it will let inflation run above target for some time. What this means is that for this year, 2021 up to 2023, the Fed forecasts that inflation rate is likely to be above 2%, 2.4% in 2021, 2% in 2022, and 2.1% in 2023. And the Fed did add another point, that there is a chance that inflation rate would run higher than that amount. And if inflation rate do run above that target, the Fed mentions that it is likely that it will continue to let those rate run up for a period of time. So in summary, for the inflation rate, we can expect inflation rate to be above 2% in the coming years. Now that we have taken a look for the projections for the interest rates and inflation rate in the coming years, let's take a look at the potential value that your money is losing each year based on these projections. So how much are you losing? To determine the real rate of return, we need to take the interest rates that we are getting on our money minus the inflation rate of the economy. Earlier on, we saw the Fed's projections for the interest rates in the coming years, and their projection was 0.1%. So that is the projected interest rates for the coming years. The next one is the inflation rate. The projected inflation rate by the Fed is around 2.1%. So the real rate of return that we'll be getting on our money if we put them in the banks will be negative 2%. Think about it. By putting your money in banks, each year your money is losing 2% of its value. Is that risky? Definitely. It's very risky to put your money in banks, because by putting your money in banks, your money is guaranteed to lose its value over time. 2% each year to be specific. Sure, some commercial banks may be offering a higher interest rates on their saving accounts. For example, if we take a look at this one, these are some of the best savings account in Singapore, where I'm from. If we take a look at DBS Multiplier, it has interest rates of about 0.4% to 0.8%. And for UOB one, the interest rates is 0.5%. OCBC is between 0.35% to 0.45%. For Maybank, it's 0.48% to 2.93%, and so on and so forth. So yes, even though these savings account with these banks offer interest rates which are a bit higher, do you see that even though with these higher interest rates, these interest rates are still lower than the projected inflation rate of 2.1%. So even putting your money into this savings account with these banks which offer higher interest rates, you are still guaranteed to lose money over time because of inflation. So putting money in banks is a sure way for you to lose the value of your money over time. Then you may be asking, So Linus, now that we know by putting our money in banks we are losing the value of our money over time, how can we inflation proof our money? To inflation proof your money, we need to understand this concept and this formula. This is the formula that we have briefly mentioned earlier on. The real rate of return that we are getting on our money is the returns that we are getting, or the interest rates on our money, minus the inflation rate. In order to get a positive real return on our money, the inflation rate has to be lower than our returns or our interest rates on our money. If we can ensure that the returns or the interest rates on our money is higher than the inflation rate, that is how we can get a positive real return on our money and inflation proof our money. Then the next question is, how do we find something that gives us returns or interest rates that are higher than the inflation rate? One thing is for sure, we do not want to put all our money in banks, because putting money in banks, like I mentioned earlier on, is a surefire way for you to lose the value of your money over time. To inflation proof our money, we must invest, be it in the stock market, in cryptocurrencies or real estate, and so on and so forth. We need to invest in assets which give us a rate of return or interest rates which are higher than the inflation rate. In essence, any assets that gives us a rate of return or interest rate that are equal to or greater than 2% is how we inflation proof our money. For me, I believe that investing in the stock market is one of the best way to inflation proof my money. This is a screenshot of one of my stock portfolio for last year. Last year, I managed to generate around 50% returns in the stock market. That is the returns that I'm getting from the asset that I invest in, which is the stock market. And if we take a look at the inflation rate for last year, inflation rate in the US last year was 1.4%. So to find the real rate of return on my money, I take the returns that I generated from the stock market minus the inflation rate for last year. The real rate of return that I'm getting on my money is more than 50%. And that is how you inflation proof your money, by generating returns in the assets that you are investing in. So for my case, I invest in the stock market, and the returns that I get in the stock market is more than 50%. And from there, we subtract the inflation rate, which is 1.4%. So my real rate of return is a positive number, which means that for last year, I managed to inflation proof my money. So if you want to inflation proof your money, you must invest. It doesn't necessarily have to be in the stock market. But for me, my preference is investing in the stock market, because I have the knowledge and the skill to invest in the stock market. And it's also because I personally believe that the stock market is one of the best ways to not only inflation proof your money, but also to grow my capital. So there are quite a number of assets that you can invest in. But one thing for sure is that you do not want to put all of your money in banks. Maybe right now while watching this video, you do not have the knowledge or skill to invest in the stock market just yet. But this doesn't mean you cannot invest in the stock market. You can still choose to invest in the stock market using this simple tool. And this tool is the S&P 500. By investing in the S&P 500, you do not need to know how to pick individual companies. Because by investing in the S&P 500, you are investing in an index which tracks the 500 largest companies in the US. And according to historical records, the average annual return since its inception in 1926 through 2018 is approximately 10 to 11%. And the average annual return since adopting 500 stocks into the index in 1957 through 2018 is roughly 8%. So even if we take the lower example, an inflation rate to be 2%, you are still making a positive 6% real rate of return. Can you see how by investing in the S&P 500, you are able to inflation proof your money? Right, so even though the Fed has sentenced cash to failure, this doesn't mean that we cannot do anything about it. What we can do is invest in assets which gives us a higher rate of return compared to the inflation rate, and that is how we can not only inflation proof our money, but also grow our money at the same time. And the stock market is one of the best ways to achieve just that. If you have learned something from this video, smash the like button, because it will really help the channel grow and allow me to produce more content such as this. And if you are new to this channel and haven't already subscribed, make sure you subscribe to this channel, because each week I release new videos about investing, trading, and the stock market. I'll see you in those other videos. To your financial success.